And so there's still chatter about, oh, golly, they're manipulating the market. Yeah, they may be, but are they winning? No. Silver's not $35. It's not 50. They lost. And, they're going to be trampled if they try to get in the way.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 2nd through March 9th, 2026, while supplies last. First this week, 90% U.S. constitutional mixed junk silver is $1.25 below spot. Next, 2026 1-ounce silver eagles are just $13.50 over spot. 1-ounce gold Rand bars are only $120 over spot. And finally, MS64 pre-1933 gold Saint Gaudens coins are just $195 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. I was reading through your last weekend report, and there are a lot of concerning things in there. You talk about how the financial sector is really set up to collapse. What do you think the ramifications will be for the economy and the financial system, and especially the banks?
Well, another point I made in that same report was that while the Fed has the two mandates, the unemployment, especially the one they're focused on now, and the inflation one, but they'll shift to the unemployment. Now they got a good excuse. We had a data point today that they could latch onto. And then coupled with that, though, our analysis of the financial sector, in particular the two major credit card companies, and then a handful of the largest banks, not all of them, but too many of them are intra-month anyway, breaking below levels that are not acceptable on momentum. Now, of course, it's not the end of the month, and maybe they get a rally. And we suggested in the weekend report that here's Powell. He's got till mid-May. He's resisted Trump and shown that he's, quote, a man of integrity and not going to put up with the presidential controls and all that stuff. But on the other hand, when he's faced with data points that he can use as a rationale, like the unemployment, but especially what's going on in certain of the financial categories, especially the bigger banks, technically speaking, he's fully aware of that. Now, that may not be one of their mandates, but you can bet he's getting phone calls, that are related to credit and problems of that sort. So our suggestion was, don't be surprised if there's a surprise rate cut. And we know they have a meeting this month even. And I know they said, oh, no, we're going to stay. But now they got enough excuse it wouldn't shock us to see them goose the market up, albeit briefly, including the financial sector, so that he goes down in history not as somebody who fought Trump politically through the end, hence ignored certain things that were negative that were going on under his feet, like the banking situation, the drop in the credit card company, et cetera. Instead, show that he acted, appropriately. In other words, ahead of the events to try to prevent them. So the question is, he's under a lot of pressure right now, Powell. And it wouldn't shock us that he's now got excuses to go ahead and cut. And that may be the kind of goosing that the market needs to get that one more new high. We've been arguing for some months now, this holding pattern in the S&P. If you look at an S&P monthly chart, you'll see 6 months of dead quiet, just around below 7,000. And it just, our technical work, short-term intermediate stuff, says, hey, you need to go up. You need to cleanse out those highs. You need to have something to cheer about. And then the vulnerability could set in. But before that, it's far better, even if you're a bear, to want that rally. And could the Fed provide it? Could be.
You also mentioned how this really parallels what we saw in 2007, really running up to the 2008 financial crisis, where the financial sector tanked first. The S&P continued to make all-time highs. The Fed had rate cuts and right before the huge crash. So can you explain a bit more about this, how this really is kind of a repeat potentially of 2008?
Yeah, everybody's looking at tech and AI and so forth as the key. Okay, admittedly, it's important because that sector was the leader, at least in the last couple of years of the very aged bull market that's been underway since the 2009 low. So yeah, you got to watch the leader, because when the leader stumbles or fails, don't assume you're going to escape it. It's taking you down. But few people are looking at the financials, and they're too core of a sector to ignore, especially for the central bank. And when you run relative performance, and some people have noted this just by seeing that XLF, for example, has been oozing down, at a moderate pace while the S&P has been going sideways. Well, that means the financials are underperforming, and you can technically measure that. And that's what happened in 2007. The financials actually peaked in price in the first half of that year and dropped. S&P dropped too. But then there was another turnaround in September and October of 2007 where the S&P made a new high. Financials were nowhere near their high. And financials had already done severe damage technically to their major trend, so that rally you could ignore it. And sure enough, that was a warning. Several months, handful of months before the S&P actually topped with a glorious news story, the surprise rate cut. So you got to watch the financials, because we know we have high yields, and they've been choking for a long time at high levels. T-bond prices at very low levels. And watch the T-bond market too, T-bond futures. They're anemic. They're weak. And yet the Fed's been buying T-bonds since November. And yet that market doesn't go up. It just goes dead. All they've been doing is keep it from going down. Well, unfortunately, that causes people with long-term debt that's linked to the long end of the debt market to choke. There's no relief. So the Fed's going to have to come in here. And the question is, will they do it before Powell leaves? Which everybody knows they will then. But the question is, maybe we get a surprise and Powell cuts. And that could do a couple things. One, goose the stock market falsely, as it did in 2007, October. But also provide more broad fuel to the monetary metals. Because when central banks go berserk like they're doing in Japan right now for the same problem, a government debt problem. We know we have government debt problems, not just in Japan, but here as well. They're trying to keep that fire low. And we have other problems in some major European countries and in the UK. A government debt paper, not being what it's worth. So that can't happen. Investors cannot have that asset category be in jeopardy. Otherwise, hands go in the air screaming, And this helps gold and silver, because when they print money to save themselves, which means further destroy the real buying power of the dollar or the euro or the yen, what does it do? It helps fuel gold.
And I did want to ask you about that, precious metals, both gold and silver. Last time we had you on, it was right before silver crashed significantly from about 120 to below 70 in a matter of days. Now things seem to have stabilized, and you've talked about how the correction is over. Can you expand on this?
Yeah, the silver drop, we expected one. We frankly didn't expect it to occur in late January. We thought maybe it'd be late February or March. We had a major, what you call a green light go on, that informed us through our studies that when the spread of silver breaks out versus gold, meaning when you plot the relative performance of silver on a chart relative to an ounce of gold, divide silver into gold, express it as a percent, there was a technical level to break through that would indicate, silver's breaking out. Silver's going to launch versus gold. That was the November close. Okay, that occurred. When this has occurred before, over the past 50 years. What's happened in the following couple quarters is an explosion in the net price of silver. While gold still goes up, silver goes up a lot more. And it usually gets its job done in a couple quarters. Well, start from November, meaning December's month 1, okay, then month 2. So we kind of thought maybe you get into month 3 or so, there's usually a midpoint stumble. This one was sharper than we had expected, but it doesn't do any damage to our long-term momentum trends of gold or silver whatsoever. Yes, you did some short-term damage. And in fact, you said a couple of days, you were right. That break was actually 1 day and a half. One day, the last day of January and into the first trading day of February, and then you made your low. Since then, silver has gelled, and we're now $20 off that low or so, or 18 or so off that low. And we're still well below the high. But gold, interestingly, though silver's still been outperforming gold even since November, went back up and had a close last week, I think it was, at 53.11 on the front month contract, which would be the April future right now. If you go back and look to January, not the high trade, admittedly that got up to 5,600, but the high close on a daily basis was 53.40. So effectively, we came back up to it, to the high on a closing basis daily, and basically matched it in gold. And then with that news of the war, which people thought, oh, you buy that. No, you don't. You don't buy war news in the monetary metals. Suckers come in and buy it, in which case they're vulnerable to get kicked in the shin. And sure enough, they did. If you bought gold in the rally early this week, it was up to 96, I think. They bagged them. Okay. Now we're trading 83, 84. Okay. But gold went back to its high effectively. Now that's not the way gold behaves if it's topping. Whenever gold has made a major top or major bear low, 2011 high, 2015 low, it's isolated. You don't come back to that low or come back to that high. You may try to, but you never do. Gold went back up and basically matched on the daily close, the peak close of January. And then when you look at the miners, heck, they went back to their highs and even marginally nipped them out. That is, again, a sign that the air is not so thin up here that it's a top. In other words, you get up there and you fail, and then that's it. This time we go all the way back up to the highs again in the miners. Yeah, they pulled back since, but you don't go up and make double tops. That's not the way the monetary metals have ever peaked or bottomed, with double tops. They go through it. It's setting up a triple top breakout. Now, silver's the laggard right now, but you got to look at the mama metal and the miners, and they're saying, hey, this is not as weak looking as you think it is. Anyway, that's our view right now, is that the metals are basing. We suspect by the end of this month, you'll see much more evidence of that. And by next month, probably new highs.
It has been quite exciting tracking this with you. You've been right every step of the way, which is I was shocked originally when you said silver should go to 60 to 70 within months when we were at about 30. And I was shocked even more when you said 1 to 200. But you've just been right every step of the way here. Now what you're saying is that you're not offering buy signals for anybody at the moment, given how much silver has run. But you do still see that the most undervalued or the greatest potential gain is in the silver miners. Can you expand on that?
Silver and silver miners. In other words, of the two metals, I'd buy silver. Okay. Of the two mining categories, gold miners or silver miners, I'd buy silver miners. This is a technical statement. Silver broke out versus gold on a relative performance basis, and despite the sharp pullback at the end of January, that spread did not break down. In other words, the relative performance breakout we had in November has not been negated, okay? And then when we look at silver miners and plot them in relation to gold miners on a relative performance basis, again, a spread chart, they've broken out. In fact, they broke out like a couple quarters ago. And sure enough, they've done better than the gold miners on a relative gain basis. And so those two factors echo each other. They're saying silver miners. So it's not just silver versus gold, it's their miners, which are vastly underpriced, if you look historically, to the gold miners. They're very cheap in relation to. And so is silver, still very cheap in relation to gold. So I think both of them have a lot more to go, not just in net price, but in their relative valuation to gold.
Do you want to expand a bit more on that? That I guess you're saying the relative valuations, that's something that's really important to a lot of our viewers because we see, as you mentioned, the degradation of the money unit. So just pricing things in dollars is not always the best option.
The dollar decays, the quantity of dollars, M2, for example, basically increases 80 to 90% every 10 years. What a worthless piece of paper. I mean, I've said it probably on your show before, but your granddad built a house for $4,500, your father for $45,000, and now if you want a median priced home, it's $450,000. Is that because houses have gone up in value? No, it's because the money unit's collapsing continually. And so when the Fed panics over issues like their government paper not being perceived to be stable, and they print to save their bonds, or they print to help financial sector because they realize that's the one they got to really protect, even though it's not a mandate. They print money. They cut rates, then they print money, and it gives them an excuse to even push further on the pedal. And the Japanese are doing it. In fact, the new prime minister over there was elected, a year ago or so. She claimed to be sort of like a replica of Trump, intellectually speaking. And she used the phrase print, print, print. That's what she's going to do to defend those bonds. Well, I mean, that's like, that's hardly what you call a free market point of view. That means the money unit's going to be destroyed by the government just to protect their paper, okay, which doesn't ultimately work. But ultimately, it does do something. It drives up real money, gold and silver. If you think about this another way too, silver was capped for 50 years at $50, with lows down around $4 or $5. Okay, so dimensionality there of $45. If you take that dimension and add it to the high, which is 50, you come up with a swing target of 95. If you go back and you'll notice on the way up to 120, there was a fighting effort in mid-90s. Some people say, hey, we've reached the swing objective. And they tried to top it and it didn't work. It blew up to 120, okay? So meaning that didn't work. But if you take that ratio between the lows of that 50-year range and the high, that's a tenfold range in dimensionality. Tenfold times 50 is what? Okay, you get the point. Also, if you factor in the decay of the money unit, M2, how much has it increased since 1980? You can do your own homework on this. Or since 2011, even when we were at $50 the second time. That would project silver like 250 to 500 just to get even with its real dollar value. And also when you look at things like copper and lead, they had a range like silver had for decades. Silver stayed in its range up till just recently. They broke out in 2006, 2005 for copper and 2007 for lead. And what did they do in the couple quarters after that? Quadrupled in price and then lived in a new reality. How come silver wasn't able to do that? Gold made new highs each time and made a bull move. Eightfold gain, constantly blowing out the prior high, but silver wasn't allowed to. Well, whoever tried to restrain that didn't succeed. Okay. And so there's still chatter about, oh, golly, they're manipulating the market. Yeah, they may be, but are they winning? No. Silver's not $35. It's not 50. They lost. And, they're going to be trampled if they try to get in the way. Especially if you go back, if you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely by early to midsummer.
No, the difference in your analysis that I've seen as we've continued to talk to you here is you're obviously looking at momentum rather than just price. And a lot of people analyzing the charts throughout this run for silver have been calling tops here and there and saying, oh, it's way overbought. Look at the RSI. One of the things that I just find really interesting is obviously you've been accurate this whole time, but also that now certain mainstream voices are seeming to echo what you're saying. For example, at Bank of America, one of their analysts is projecting $130 to around $300 silver by the end of 2026, which is pretty close. I know you're more bullish than that, but what is your take on it? It seems like even in mainstream now, the extreme bullishness of silver can be seen.
Some of the biggies, yeah. I think JP Morgan and also another major bank, I'm not sure, may have been Morgan Stanley, projected gold reaching a level we've mentioned a year or so ago. That's 8,000 plus. And the rationale for that, and I'll repeat it, I've probably said it on your show before, it is nothing but a replication of the two prior bull moves in gold. They were both eightfold dimension. Bear low, bull high, bear low to bull high, 8 times gain from the low. Well, our low was what? 1,050. You do the math. Okay. Now suddenly JP Morgan comes up with a number of 9,200 or something as a target based on some fundamental analysis they did. Fine. But it's interesting to hear that now, you know, a year after we've been saying, hey, that's no big deal to even go 8,000. We've done it twice before, eightfold move. And consider the background that we're living in, the fundamentals that are underway, government debt problems. That wasn't the issue in 2007 to 9. It was mortgages. Now we got government debt being questionable, okay? Long-term debt. Whoa. I mean, that's a major asset category. It's bigger than the stock market. It used to be an alternative to the stock market. If the stock market was in trouble, you could buy bonds. In fact, that worked. 2007 to 9, stock market imploded, bonds went up. So did gold during that time. 2000 to 2002, stock market got cut in half, NASDAQ dropped 80%. Gold went up during that time, bonds went up during that time. Right now, bonds are suddenly, not so sure they're going up. Yields might, but the prices isn't. So what does that leave you with? One alternative. And it's never the case in history that when you have an asset class implosion like that everything goes down. Yeah, there might be a moment here or there where gold goes down with the stock market, but basically its trend will be opposite a stock market bear. And so if all of a sudden you don't even have T-bonds as an alternative, wow, you have a vacuum. And anybody who is continually calling for tops in gold and silver, it's a continual process. And every time they do, and I'd have never seen a bull market top in gold where everybody screamed it was a top. Okay, you know, in fact, in 2012, when we put out we called the top in the gold market, we said it's over. We hit 1920, and we dropped into January of 2012, and we said that was it. It's over. Only 2 months off the high or so. Over the next year, gold went sideways, but never got back to the high. And we had complaining subscribers. We had to write a report called Open Letter to the Gold Bulls. Okay. You know, explaining to them, sorry, we know you love it. It's good in the long term, but it's going down. And we gave them the technical reason. Right now, we have 0 technical long-term reasons to assume gold has made a top or silver. So it's a totally different situation, yet everybody's crying, it's over. I love it.
Do you anticipate that the, I guess, normal technical analysis that may project silver going back to 54, right, or going back to that level just because it, you know, that's where it broke out of, right? Do you anticipate that analysis that so many people are doing just isn't going to work this time because of the circumstances, right?
They've been saying it all the way up, not with silver, but with gold. Every time gold makes a high, a prominent high, it usually will plateau for quite a few months. Look, go back to April, May, June, July. It took like 5 months for it to get up out of that range it was at. And every time we do, everybody who calls for a correction thinks it's going to go back to the high end of the prior range. And if you go back and look, it doesn't do that. It hasn't done that. It's had drops, but it never goes back to the orthodox level where people say that was old resistance, it's now support. So they're using a rationale that isn't working. And we have the same thing going on right now. Silver's going to go back to 50. That's the top. Well, anything could happen, I guess. But our work says no. It says you better be prepared, because if you don't break this market real soon, further than what we saw on the first trading day of February, basically you could circle it on all the miners, on gold, on silver, just circle that. And look where you are now compared to that. You better go take that low out soon, or you better think a different way. This is not a normal bull market. So the orthodoxies of, it's overbought. Yeah, in a normal situation, yes, it is. But that doesn't mean this is a normal situation. And therefore, you can get overbought and stay overbought longer than you might think, in which case you missed the move. Okay? So anyway, that's our assessment right now. We think that we're not issuing any long-term buys, and the reason is we issued 3 over the last year or so. One was in April, May, June of 2025. Gold was coming up back toward 35 again. We issued one in early 24 when it was coming up through 25 to 26. That was a major buy for us. We knew it was going to blow out the 25 level, which it finally did, and it zoomed into the 30s. Then it congested for a whole year with tops at 35. We had a pullback into April last year. Started moving back up. When we started to move back toward those old dual highs at 35 plus, we said, this time it's different. It's going to blow through. It's going to accelerate. That was our second major buy. Our third and final major buy, based on long-term metrics, was the November close. That's when silver broke out versus gold. We're not going to offer any more buys. In other words, if you're buying now or later, you're on your own. Yes, you're probably going to make money, but it's not an optimal point of entry. And that's what we try to offer.
And our viewers can go to olivermsa.com to subscribe to your newsletter there. Highly recommended. Are there any last thoughts for our viewers that you'd like to leave?
No, I think this is going to be a historic year. And when you look back on it, you're going to say, wow, what a year it was. And everything, not just silver and gold. But I think the stock market is topping. We still have a suspicion that it needs to spike one more time, at least the S&P does, take out that 7,000 level. And then if it aborts back down, then you start your bear market. The people will recognize it as a bear market. But that could be months away. I mean, I don't think the stock market necessarily is going to implode here. It hasn't done enough damage yet. It looks like it could still waddle around and maybe not start to see real sharp decline, the kind that would affect people, margin calls and so forth, until maybe summer or later. So everybody who's fearful that, oh gosh, if the stock market goes down, my gold miners will go down. Well, yeah, well, where will gold miners be if the stock market doesn't go down now? The stock market instead says, oh, I'm going to spend a couple more months up here. A couple months in the miners can be incredible, as we know. So anyway, this is going to be a great year, 2026.
Fantastic. Well, Michael, once again, thank you so much for your time today and insights. You have a good day, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for March 2nd through March 9th, 2026, while supplies last. First this week, 90% U.S. constitutional mixed junk silver is $1.25 below spot. Next, 2026 1-ounce silver eagles are just $13.50 over spot. 1-ounce gold Rand bars are only $120 over spot. And finally, MS64 pre-1933 gold Saint Gaudens coins are just $195 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.